Hello everyone, welcome to Unit 1, Lecture 5. So today's discussion will cover how does a mortgage work and also what is the student debt bubble. So this material comes from Chapter 7 in addition to some supplemental material, but our learning objectives, first of all, for how does a mortgage work are one, understand some key definitions. So what is a mortgage, what is a down payment, who is an originator, who is a lien. Also, different types of borrowers, prime, alt A, and subprime borrowers. We'll talk about fixed rate mortgages and also adjustable rate mortgages. We'll talk about refinancing and home equity loans, and we'll also discuss this thing called points. Then we'll move forward into how to calculate monthly mortgage payments and creating an amortization schedule. So, first, what is a mortgage? So a mortgage is one of the most common financial instruments. Many of us will have a mortgage at some point in our life. Mortgages are loans to individuals or businesses to purchase a home, land, or other real estate. So office or apartment buildings, farms, but some type of physical property. What's unique about mortgages is that they are backed by a specific piece of property so that if the borrower does default, the financial institution can take ownership of that piece of property. If you remember back to our first lecture, I discussed that during the Roman Empire, Julius Caesar was the first to declare that banks could actually seize land if a mortgage was not paid. This was your first concept of using a physical piece of property to back a particular loan. Now, there are three reasons to cover a mortgage or to cover mortgage markets separately from that of bond or stock markets. We already kind of discussed stock markets. We'll discuss the bond market in the next unit. But there are three main reasons why we cover mortgage markets separately. One is that mortgage markets are actually backed by a specific piece of real property. So we talked about this real property being an office, an apartment building, a farm. Whereas with bonds, they could be debentures secured by no physical property. And then in the event of stocks, you have some general claim to assets. And also in the same event, you have a general claim to assets with bonds. Mortgages are actually backed by a specific piece of property. Secondly, mortgages have no set size or denomination for primary mortgages. So with these primary mortgages, there's not a set size or denomination. And I know I don't have this here on the slide, so just please kind of bear with me. The primary mortgage market is broken down into four basic types of categories. The first type of mortgage would be a home mortgage. So this is a situation where it's a 1 to 4 person family dwelling, but the first type of mortgage within the primary mortgage market is a home mortgage. The second type of primary mortgage market category would be multifamily. So I can add these here so you don't have to just listen. We have a primary mortgage market. So once again, we're talking about the mortgage market, primary just being the initial offering of the mortgages. The first type or the first category would be a home mortgage, a 1 to 4 person family dwelling. Second category would be multifamily. So multifamily would be apartment complexes, for example. The third category would be commercial mortgages being your office buildings. And then 4 would be farming, so land for farming. So these are the 4 basic categories of your primary mortgage market. That's our second reason on why we cover mortgage markets separately, is that there's no set size or denomination. You can have multiple sizes or denominations in these different types of mortgages. And then 3, the third reason why we cover the mortgage market separately is that typical issuers in mortgage market, so these individuals that receive mortgages, is much different from your typical issuer with other financial markets. So the corporations or governments that issue these bonds or stocks. So these are the 3 main reasons why we cover the mortgage market separately from the bond market and stock market. So moving forward, some key mortgage terms. First, within a mortgage, you have this thing that is called a down payment. A down payment is a portion of the purchase price of the property that the borrower pays up front. So typically, this down payment is at least 20% of the property value. Typically, if it's less than 20%, you're going to need some type of private mortgage insurance, so PMI, which is just another fee that you would end up having to pay. What this private mortgage insurance actually does is it guarantees that some payment is received in the event of a default. So typically, when you have a down payment on a home, when you're taking out a mortgage, your down payment should end up being at least 20% of that property value, and you pay this up front. Secondly, or the second key term is an originator. An originator is essentially a financial institution. They are the original lender who underwrite the loan, they process the necessary documents, and they provide funds to the homeowners. So during the financial crisis, these originators, these financial institutions, were providing loans to individuals that were unable to make the necessary payments. However, these originators didn't really care because these loans were being packaged together and sold off, so where if the borrower defaulted, it really wasn't on them. So during the financial crisis, we had some major problems with incentives on who these originators were actually loaning out or providing these mortgages to, and that's one of the reasons why the financial crisis actually occurred, is that these originators were actually providing loans to individuals that were not able to make their mortgage payments. The third term is a lien. A lien is a public record that is attached to the property title that gives the financial institution the right to sell the property if the borrower defaults. So right here we see that we are dealing with the giving the right to the financial institution to sell this property. Again, during the financial crisis, one of the main issues was that we didn't really know which financial institution actually owned the lien. So when they were creating these loans and then packaging them together and selling them elsewhere, it was really difficult that when an individual actually went into foreclosure on their property, which financial institution actually owned this lien right and was able to actually sell the property. So during the financial crisis, the originator and the lien were very key components of what was going on within the financial crisis. Now, what goes into the interest rate that is charged on these different mortgages? So what goes into it? Well, credit classification. Credit classification actually determines the interest rate on these mortgages. So what is credit classification? Credit classification is determined based on a FICO score. FICO stands for the Fair Isaac Corporation, which actually calculates a person's credit score. We'll talk about more about credit score here in a little bit, but basically the definition would be the credit quality score based on whether you pay your bills on time, what amount of debt do you have, what is your how many lines of credit do you have, those different types of categories. The average FICO score is around 700. We'll talk about some different ways that you can raise your credit score here in the following slide, but that is one aspect of what goes into credit classification. The second aspect would be the loan to value ratio. So this is simply the size of the loan relative to the value of the property. And then the third category for credit classification is your payment to income ratio. This is your mortgage payment relative to your monthly income. So these three aspects go into credit classification and what interest rate is charged on a loan. And when we talk about borrowers, we have three main types of borrowers. The first would be a prime borrower. This is your highest credit quality borrowers. They would receive the lowest interest rates on these mortgages. You also have Alt-A borrowers. Alt-A borrowers are borrowers who have high credit scores, but they have variable incomes or are unable or unwilling to document a stable income history. So they have a high credit score, but they're not able or willing to document their stable income history. And then you have the lowest, or you have the third category, which is the lowest of these three, which would be a subprime borrower. A subprime borrower is a borrower whose credit has been impaired, but generally have sufficient equity in their homes to mitigate the credit exposure. I don't particularly like this definition, so what I would use is the textbook definition, which states that that subprime borrowers or subprime mortgages are mortgages to borrowers who have weakened credit histories. So it really kind of summarizes it into the fact that these borrowers are the individuals that have weakened credit or have poor credit histories that have these mortgages. So before the financial crisis, we had more subprime mortgages, and this was a key aspect of the financial crisis, is that those originators on the previous slide were providing mortgages to a lot of these subprime borrowers, and eventually these subprime borrowers defaulted and were not able to make the payments on their mortgages. So as I mentioned, talking about your FICO score and talking about some different ways that you can raise a low credit score. Your FICO score is just one credit score. So as you can see here down the bottom left corner, you don't have just one credit score. You have some different companies that will assess your credit history. As I stated, your average FICO score is around 700. Let's look at the right-hand side here as some tactics on how you can actually raise a low credit score. This is from a snippet from CNBC. One, always make your payments on time. There's some research out and discussions that showcase that even making one payment late could reduce your credit score. So really try to focus on making all of your payments on time. Don't max out all your credit cards. So aim to use 30% or less of your available or your allotted credit. Pay down your debt, so pay down your debt as quickly as possible, and regularly check your credit reports. It used to be thought that if you check your credit score, it would actually decrease your credit score, which it does if companies are checking your credit score. So if you apply for a car loan and they check your credit score, that is something that would have a negative impact on the number of times that companies or entities check your credit score. But you personally, there's a lot of different ways that you can check your credit card or check your credit score. I know Chase, Bank of America, a lot of financial institutions provide that service for free using Experian, using FICO, using different credit rating agencies. But as you can see here, you can also check for free at annualcreditreport.com. So, what are some different types of mortgages? Well, typically a mortgage maturity has a 15 to 30 year period, and most of these mortgages are either fixed or adjustable rate. So these are typically either 15-year or 30-year mortgages. Let's first talk about a fixed rate mortgage, sometimes abbreviated FRM. It is a mortgage that locks in the borrower's interest rate and thus the required monthly payment over the life of the mortgage. So you have a fixed interest rate, a fixed payment. That is what a fixed rate mortgage is. You also have what are called adjustable rate mortgages, or ARMs. So this is a mortgage in which the interest rate is tied to a market interest rate. So the required monthly payments can change over the life of the mortgage. Oftentimes there is a cap on this, but the thought process or the concept behind an adjustable rate mortgage is if the interest rates go up, it can be very costly. If the interest rates go up, then your payments would also go up. This is basically what happened during the financial crisis. So prior to the financial crisis, about mid-2002 to mid-2004, you had very low interest rates. But then after mid-2004, the Fed increased the interest rates and allowed those subprime borrowers, those borrowers that had poor credit histories, all of a sudden were unable to make their loan payments or make these mortgage payments, and they end up defaulting on their mortgages. So this was a key component or a key factor into the financial crisis were these adjustable rate mortgages. There is a third type of mortgage called a balloon payment mortgage. And with the balloon payment mortgage, this is a mortgage that requires a fixed monthly interest payment. So typically it's just the interest amount or an interest expense for a 3 to 5 year period. And then after that 3 to 5 year period, you would pay the full amount of the mortgage principal, which is called a balloon payment, a large payment bigger than the rest of the payments. You can see a visual of this payment structure on pages 212 to 213 in your ebook. Oftentimes, at the end of the 3 to 5 year period, you would hope to refinance this balloon payment mortgage, but that refinance is not guaranteed. So that's a third type of mortgage that is not listed here on this slide. Another characteristic of mortgages is this thing called points. These are also called discount points, and these are different from a down payment. Okay, so what are points and why did I emphasize that they are different from a down payment? Well, points are fees assessed when a mortgage is issued. So once again, when the mortgage is being originated, and 1 point paid up front is equal to 1% of the mortgage's principal value. So both points and down payments occur at the origination of a loan. The down payment actually reduces the amount of the mortgage payment, whereas points actually decrease the amount or decrease the interest payment or the interest rate in essence. So let's just kind of move forward with what an actual point is. So 1 point paid up front is equal to 1% of the mortgage's principal value. So let's say, for example, you get 2 points on a $100,000 mortgage. That would be a $2,000 upfront cost. And so the loan is effectively $98,000, and the bank reduces the interest rate. So you're actually paying a lower interest rate on this loan. But what's unique about this is that you're still making a payment that is based on that $100,000 mortgage. So depending on the expected length of the mortgage, it may or may not be beneficial to pay more upfront and receive a lower interest rate. Before I go into an example there, I just kind of want to reiterate the difference between a point and a down payment. A down payment is some percentage of the value of the property, and it decreases the amount of the loan that you're paying, or decreases the amount of the loan that you'll end up paying off. Whereas a point is an upfront payment that decreases the interest rate on the mortgage, but you still calculate your payment on the original mortgage amount. So hopefully that makes sense. If you have any questions, don't hesitate to reach out. But going back to this third bullet, depending on the expected length of the mortgage, it may or may not be beneficial to pay more upfront and receive a lower interest rate. Basically, what you would need to do is you would want to find the present value of the savings and then compare it to the amount of points that you'd be paying upfront. It's all about the present value of the future cash flows and comparing it to that present value upfront cost. This is discussed on page 220 in your textbook if you want some further clarification. But there's also a rule of thumb with points that says if you plan to stay in the home for greater than 5 years, it may make sense to pay more points up front. So once again, it would be an analysis of comparing the present value of the future savings in comparison to the points that you pay up front, but that's just a general rule of thumb when it comes to points. Some other fees. I'm going to go through these definitions very quickly. You have application fees, which cover the issuer's initial costs of processing the mortgage application and obtaining a credit report. You also have the title search, which confirms the borrower's legal ownership of the mortgage property and ensures there are no outstanding claims against that property. There's title insurance, protects the lender against an error in the title search. There is the appraisal fee, which covers the cost of an independent appraisal of the value of the mortgage property. There's a loan origination fee, covers the remaining costs of mortgage, covers the remaining costs of the mortgage issuer for processing the mortgage application and completing the loan. There's a closing agent and review fees, and then there's other costs. Key thing here is that there are a lot of definitions here that it's not really necessary that you know all these definitions. The key here is to understand that there's a lot of fees in addition to the mortgage, right? So the amount of the mortgage is not the only cost. You need to understand all of the costs that are involved in a mortgage when you're doing analysis on your financial situation and getting this and receiving this mortgage and what your payments will be. Okay, so moving forward into refinancing and home equity. So mortgage refinancing occurs when a borrower takes out a new mortgage at a lower rate and uses the proceeds to pay off his or her current mortgage. So an example would be, let's say you have a $400,000 mortgage. When you got that mortgage, the interest rate was, say, 5%. Now it's 4 years later and the interest rates are now 3%. What you could do is have this mortgage refinancing where you take out another loan at $400,000 or whatever your remaining balance is on your mortgage at the new 3%. And you use that loan to pay off your original mortgage, and now your payments will be restructured and based off of that new 3% interest rate. So a lot of the times, though, with mortgage refinancing, it can cost 3 to 6% of your loan's principal amount. So it's not something that you can do without any other type of fee that occurs. Basically, you want to refinance only if the savings from the refinancing outweigh those fees that I just mentioned that are associated with taking out a new mortgage. Once again, there is another rule of thumb here that says that if the interest rate on the new mortgage should be about 2 percentage points below the rate on your current mortgage for refinancing to actually make financial sense. So once again, that's not a 100% holds true rule, but it is something to kind of keep in mind if you are considering mortgage refinancing. You also can do something called a home equity loan, which allows the customer to borrow on a line of credit that is secured with a second mortgage on their home. So what is a second mortgage? A second mortgage is a loan that is secured by real estate already used to secure a first mortgage. So the interest rates on these are typically higher are typically higher on these home equity loans because of the fact that you're taking a loan that's secured by another mortgage. So this would be something where maybe you would use it for an addition onto your house, but these interest rates are usually higher than interest rates elsewhere or on other loans. So let's go into a little example of buying a house. What I would like for you to do, buying a house and calculating payments and what amount of that payment goes towards principal, interest, and so forth. Right now, I would like for you to get out your financial calculator if you don't already have it out. So you may want to pause this and grab your financial calculator. What I would like for you to do is follow along as we go through this example. So you have found a house in Nelsonville, Ohio that you want to buy. It's going to cost $127,500. The down payment is 20%. What is your down payment and what is your loan amount? So this is relatively straightforward. Hopefully you find it straightforward. But it is your first step before finding a mortgage payment. So if you are going to buy a house that costs $127,500 and you have to put down 20%, what will be your down payment? It's simply going to be 20% times $127,500. So your down payment is going to be $25,500. So that is what you put down originally, and you're going to take out a loan for the rest. So what would be the amount of your loan? It would be the initial amount of the house minus your down payment. So our loan amount will be $102,000. So once again, pretty straightforward, but it is necessary to understand this first step before you actually calculate the payment on a mortgage. So now we go into our loan specifics. So the interest rate on our loan is going to be 7.08% per year. For a 30-year fixed rate mortgage, what is your monthly payment? So this is going to be basic time value of money. So I know that if you've had me for Finance 3000, you've gone through these different types of scenarios. But if you do want a little refresher on time value of money, there are time value of money refresher slides on Blackboard within this Unit 1 folder. So please use that if you want a little refresher on how to utilize or how to calculate problems dealing with time value of money. So in this case, we have a mortgage payment of a 30-year loan. What I like to do is I always input everything on a per period basis. So if they want monthly payments, everything is going to be input in on a monthly basis. So if it's a 30-year loan with 12 payments a year, 30 times 12, a total of 360 payments. I also input the interest rate per period. So it's 7.08% per year divided by 12 months in a year for an interest rate per period of 0.59%. So this loan is charging 0.59% per month. The present value of my loan based on the previous slide is going to be $102,000. That's what I'm going to be borrowing. And the future value is going to be 0. I'm going to pay off this loan in its entirety. And then I hit compute payment, solve for payment, and I get a value that actually should showcase negative $684.10. Why is it negative? This is just showcasing that this would be a cash outflow, and this positive 102 is a cash inflow in which I'm receiving. So when you would submit your answers on your quiz, the quiz answer would be a positive $684.10. That is the amount of my payment. I would make that payment each month for the next 360 months, 30 years, and I'd pay off that $102,000 balance of which I am borrowing. So let's continue. So most mortgages do not repay all of their principal at the end. My example of the balloon mortgage is one that would pay all the principal at the end, but rather you would amortize your loan where a piece of each payment goes towards reducing principal and a piece of each payment goes towards accruing interest. So what we are going to do here is calculate how much principal and how much interest do we pay on our first and second mortgage payments. So we know from the previous slide that we're paying $684.10. How much of that $684.10 goes towards principal and how much of that $684.10 goes towards interest. So for our first monthly payment, the amount of interest is going to be the amount that I owe times the monthly interest rate. We said 7.08% per year divided by 12 is 0.59%. But this monthly interest rate in this calculation here needs to be adjusted to a decimal format. So move the decimal 2 spots to the left. The amount that I owe going into this first payment is $102,000, the amount of my loan, times 0.0059, and my interest payment this first month is going to be $601.80. We know from our previous calculation that our initial principal payment, our mortgage payment per period, is going to be $684.10. If of that $684.10, $601.80 goes towards interest that's accruing, then the amount of that payment that goes towards principal is $82.30. Okay? And then you could go ahead and do this again for your second monthly payment. So my second monthly payment is same setup, the amount that I owe times our monthly interest rate. In the first month, the amount that I owed was $102,000. However, that first month, $82.30 of my first month payment went towards reducing principal. So I'll take the initial amount that I owe, $102,000, subtract the amount of my first payment that went towards reducing principal, so the $82.30, still multiply it by the monthly interest rate of 0.0059, so 0.59%, and I get an interest payment in month 2 of $601.31. Notice that this has slightly gone down. I calculate the amount of my principal payment once again by taking my mortgage payment, which we calculated right off the bat, of $684.10 minus the amount that goes towards interest, and I end up getting a principal payment of $82.78. So relatively, when you're dealing with these amortization schedules and these fixed payments where a portion of the payment goes towards reducing principal and a portion of the payment goes towards accruing interest, you'll notice that early on a higher percentage of the payment goes towards interest that is accruing, and then later on in the loan a higher percentage of the payment goes towards reducing your principal amount. So how can I actually view this in one sheet? I can view this in an amortization schedule. So an amortization schedule shows how the monthly mortgage payments are split between principal and interest. So basically, we just did the first 2 payments, but within a 30-year monthly payment mortgage, you're going to have a total of 360 payments. It would be very tedious to do this by hand, month by month. So what we would do is we would create an Excel template, which would outline all of this pretty easily, so that we can see of that $684.10 each month that I'm paying, how much is going towards interest, how much is going towards principal, how much interest do I pay over the total amount of the loan, and so forth. So what we are going to be doing is we are going to create our mortgage's entire amortization schedule in Excel. I actually have a template in there that I have provided for you. What I want you to do is I want you to check your work. What is the amount of interest that is paid and the amount of principal that is paid in the 25th payment? It's pretty easy to see this once you have your amortization schedule there. I will post the solutions to this problem so that you can check your work with this example. And I also want you to calculate how much in interest you pay over the life of the mortgage. So once again, Blackboard does have instructions and a template for how to create an amortization schedule. I'll post the solutions. Maybe I'll create a video of me walking through this schedule, but I know you've also done this in accounting and also briefly in, at least in 3000 in my course you have. But you can use this template with your homework. Or in your quiz, you will have a problem that will ask you some basic amortization schedules in your quiz. Use the template that is provided on Blackboard to help with that Excel problem. As I mentioned previously, most mortgages are 30 years or 15 years. So suppose that you have the following alternative. Instead of taking out a 30-year mortgage, you could take out a 15-year mortgage on that same house with the same down payment. Typically, when you take out a shorter term mortgage, you receive a lower interest rate. In this case, it's 6.84% APR. Create a mortgage amortization schedule using the 15-year mortgage. So it would change what percentage of your payments goes towards interest and principal. It will also change what your monthly payment is. So what is the monthly payment would be the first thing I ask for you to calculate, and then how much in interest would you pay over the life of the loan. You will find that by taking out a lower term loan with a lower interest rate in addition, you do end up paying a substantially less amount in interest over the lifespan of that loan. So securitization. So what is securitization? Securitization, a quick little definition here, is securities packaged and sold as assets backing a publicly traded or privately held debt instrument. This was one of the main causes of the financial crisis, is that they securitized these mortgages into packages and then sold these as assets that were backing a publicly traded or privately held debt instrument. So this securitization is just a definition that basically explains what happened with the financial crisis and why the financial crisis actually, one of the main components of the financial crisis and why it occurred was because of these securities that were created from these mortgages that were sent to subprime borrowers who end up eventually defaulting on their loan obligations. So that wraps up what is a mortgage. So reviewing the concepts, be able to answer these different questions. Again, if you have any questions or if you have any concerns or uncertainties on any of these concepts, please don't hesitate to reach out. Our last section here of Unit 1, and this is supplemental material, this is not in your textbook, is what is the student debt bubble. So I think this is interesting or important information to cover because although you don't own a home, so you don't have a mortgage yet, most likely, many of the same principles that apply towards mortgages actually apply to student debt. And student debt and the student debt bubble might be something that we experience here in the upcoming years. And I know a lot of us do probably have student debt, so I do want to cover it a little bit as we wrap up here Unit 1. And it is a lot of the same principles apply towards mortgages, so it's a nice spot to kind of throw it in. So as I mentioned previously with this securitization, subprime mortgages were one of the main contributors to the financial crisis of 2007 to 2009, but some are worried that student loans could be contributing to another crisis in the near future or in the future, or at the very least could hold back economic growth. So let's just summarize a little bit of this student debt bubble. So the federal government student loan portfolio is over $1.5 trillion. The average amount of student debt is over $35,000, and over half of students, or over half of college attendees, about 54% of college attendees, actually take on debt. So this federal government student loan portfolio, over 1.5 trillion, has actually doubled over the past decade. So a lot more students are needing to take out some form of debt in order to, or take out this federal government debt in order to attend college. 2 million Americans defaulted on student loans in the last 6 years. So this is as of June 2019. So this value has changed a little bit, but I will showcase or discuss a few more details about students and defaulting on these student loans. The federal government now acknowledges that taxpayers stand to lose $31.5 billion on the student lending program over the next decade. So the federal government guarantees student loans provided by banks and nonprofit lenders. This actually went into effect in 1965 with the Federal Family Education Loan Program, the FFEL program. But the federal government basically guarantees these student loans. And who ends up paying on these unpaid government loans? Taxpayers do. So this is where the federal government is now acknowledging that these taxpayers could lose, us as taxpayers could lose $31.5 billion on this program over the next decade. And then last up, 4 in 10 recent college graduates are now in jobs that don't even require a degree, according to the New York Federal Reserve. So you've got all these students that are taking out student loans, and you have 4 in 10 recent college graduates actually receiving jobs that don't even require a college education. But however, I do want to say that there are more than 1 in 10 borrowers right now are at least 90 days behind on their student debt. And this delinquency on student debt is actually higher than any other form of credit. So you're talking about mortgages, credit cards, auto loans. And the problem with this is that these defaulted borrowers actually risk damaging their credit and their ability to borrow for homes and cars and other purchases. So I'm telling you all this information about student loans, and you guys are in this particular situation. You know, you're in college. Many of you have taken on student loans. It can be a concern, but I want to kind of showcase where I kind of want to turn the direction here in a second. So just kind of follow along. So we've talked about the housing market. You have these loans. What type of impact will this bubble or the student debt bubble possibly have on the housing market? Well, according to the Fed, home ownership among people ages 24 to 32 fell 9%. From 2005 to 2014. So 2 percentage points, or about a fifth, of the decline was tied directly to student debt. However, some economists have found that even with the burden of debt, the wage boost from getting a college degree still makes it easier for many borrowers to buy homes. College graduates are far more likely to be employed and earn more than workers with only a high school diploma. So I want you to think back to that median wage of what you would make from straight out of high school versus being a college graduate from, I think it was lecture 1 of this first unit. And we know that you made an investment in yourself to come to college. Yes, you may have student loans, but we also feel like these student loans and this ability to earn this degree can provide and open up opportunities that otherwise would not be available if you did not go through this experience. And I want to kind of point out a comment that came from the Wall Street Journal in an article called "Student Loans Change Lives." It was from Vincent Dombrowski, University of Wisconsin La Crosse, who was an accounting and finance major. And I hope that this kind of resonates with you as you are sitting here or as you are going through your college experience. Now, for those of you that have student loans, here's what Vincent had to say. Student loans have motivated me to make my investment worthwhile. After the reality set in, I realized I had no choice but to take responsibility for my future. I worked hard to do well in school and secure a job for after my graduation in May so I can begin paying back my debt. It would be wonderful if I had less student debt, but the loans were worth it. My university provided me with great teachers and a fine education. Besides, I chose to make the investment and I accepted the responsibility to pay it back. I'll be ready. I hope many of you take this same approach when thinking about your student loans and really try to get the best and get the most out of every class that you take. You do pay a lot for this education, and I do hope that you look back and say that your university, Ohio University, has set you up in a position to better yourself and better your lives. And I realize that the student debt bubble can be a concern, but I hope that you figure out or find out that it was well worth going through the experience. So moving into what are some payment options for borrowers once you graduate, what are some different ways that you can pay off these student loans? One would be a standard repayment plan, which is fixed monthly payments for up to 10 years. This actually minimizes the interest paid over the life of the loan, but maximizes your monthly payments, so you're paying less interest and really just paying off the amount that you borrowed. You also have an income-driven repayment plan, which caps your student loan repayments at 10 to 15% of your borrower's annual discretionary income. So what this allows you to do is free up some cash for saving for retirement. So instead of paying off your loan, you're investing your money in different retirement avenues or retirement accounts. You also have a graduated repayment plan, which starts with lower payments that increase every 2 years. So the final payments are higher than your standard plan, meaning that you end up increasing your salary, hopefully, over the course of this time frame and better able to meet these higher payments. And there's also called an extended repayment plan, which is monthly payments for up to 25 years. As you can probably imagine, just like with the 30-year mortgage versus a 15-year mortgage, with your extended repayment plan, you're paying a lot more interest. So you're paying a lot more than the principal amount that you're borrowing. If you want some other tips on how to pay off your student loans, for those of you that have student loans and want to learn a little bit more, check out the U.S. Education Department's online repayment estimator. Another tip would be to automate all of your loan payments. Sometimes you can get a discount. And then you can also get some help from financial planners, but you do need to be careful about different scams. Some other free resources for those of you that would like to check it out. I recommend looking at these different types of resources here. Another thing is look at this article down here at the bottom. This is primarily if you want to consolidate or refinance your debt with private lenders. So just some areas or some resources for you to be able to look at while considering how to pay off your student debt. Well, congrats. That wraps up Unit 1. That is Unit 1 here. Some essential financial questions. I like to conclude this first unit with a little key takeaway area. So some key points from this unit that you can take into your future endeavors. One is that finance today supports our current economy and facilitates economic growth and innovation. 2, the SIE exam is a helpful exam to have taken before applying to jobs in the financial services industry. That's why I will be having you take the practice exam as a means to try to get yourself prepared to actually take this exam before entering a job in the financial services industry. Through open market operations, the Federal Reserve actually influences interest rates, which then impact the wider economy. So the funds available and interest rates being charged on these different loans. The stock market allows investors to have an ownership stake in firms, whether it be through IPOs or secondary market transactions. Mortgages enable people to make large real estate purchases and pay off the principal and interest over time through amortization. And last up, the student debt crisis is a major problem facing our nation today, but there are reasonable steps that you can take to manage your own personal debt. And hopefully you realize that this debt that you are accruing, for those of you that have these student loans, is making an investment in yourself and can open up a lot of avenues for you that otherwise may not be there without this education. So once again, this wraps up Unit 1. Be sure to complete today's lecture question and also be taking or be preparing for Quiz 1 and then also exam number 1, in which you can find details on our McGraw-Hill Connect page. As always, if you have any questions, please don't hesitate to reach out. I hope you all enjoy the rest of your day. Thanks.